Disclaimer.
What I am about to tell you will either position you ahead of the biggest silver squeeze in modern history, or you'll look back wishing you had paid attention. Today is Tuesday, January 6th, 2026, and something just happened that the financial media is completely ignoring. While you were on holiday break, $215 million in silver short positions got transferred to foreign banks. Physical silver hit $130 in Tokyo, while paper trades at $76 in New York, and Wall Street just discovered they're trapped. Picture this. You're a senior risk manager at one of the major New York banks, returning to your desk Tuesday morning, January the 6th, after a relaxing holiday break with your family. You grab your coffee, log into your trading systems, and immediately your blood runs cold. While you were gone, someone transferred $215 million in silver short positions away from your desk and over to foreign banks. Not just any foreign banks, institutions that suddenly became responsible for delivering physical metal that does not exist in the quantities promised. Have you ever walked into work and discovered someone made a massive decision in your absence? Now imagine that decision could bankrupt your entire trading division. That's exactly what happened across Wall Street this week, and the timing wasn't an accident. Here's what should grab our attention. These transfers happened during the week between Christmas and New Year's Eve, that ghost period when every senior trader and risk manager takes vacation time. The same week when only junior staff members man the trading floors, following predetermined protocols without the authority to question unusual transactions. According to multiple sources in the fixed income space, this is the traditional window when institutional players reposition before anyone with real decision-making power returns to notice the changes. But this year, something different happened during that quiet week. The Federal Reserve injected $74.6 billion into the repo market. On December 31st, that's not just big, it's the largest single-day repo operation in Federal Reserve history. Think about what that means for a moment. Our central bank pumped nearly $75 billion into the overnight lending market on New Year's Eve. When most Americans were preparing for parties and champagne toasts, the Fed was responding to something urgent happening in the plumbing of our financial system, something that required immediate action even on a holiday. Now here's where things get interesting. While our banking system needed that record emergency injection, physical silver was trading at wildly different prices depending on where you tried to buy it. In Tokyo, dealers were selling 1 kilogram bars for $130 per ounce. Not $76 like the paper price showed on our COMEX futures screens in New York. $130 in actual physical metal, changing hands between buyers and sellers. That's a 54 gap between what the paper market claims silver is worth and what people will actually pay to hold real metal in their hands. You might be thinking, well, if silver costs $76 in New York and $130 in Tokyo, wouldn't traders just buy in New York and sell in Tokyo, pocketing that $54 difference? Under normal circumstances, absolutely. That's called arbitrage, and it's supposed to keep prices aligned across global markets. But according to industry sources at Brinks and Loomis, the two major precious metals, transport companies, their armored vehicles are fully booked until February. You literally cannot move large quantities of silver from American vaults to Asian buyers right now, even if you're willing to pay premium shipping rates. This means our global pricing system for silver has completely fractured. The connection between paper contracts in New York and physical metal in Asia has broken down so thoroughly that a 54 price gap can persist for weeks without any mechanism to close it. That's not how functioning markets are supposed to work. That's how markets work right before something breaks. Then, on January 1st, while most of us were nursing hangovers, China implemented new export licensing requirements for silver refining. This wasn't some surprise announcement. The policy had been planned for months. But the timing matters because China controls 65% of global silver refining capacity. Even if mines in Mexico or Peru dig silver ore out of the ground, most of that material gets shipped to Chinese refineries to be processed into the bars and coins that manufacturers actually need. According to the China Non-Ferrous Metals Industry Association, these new licensing requirements mean any Chinese refinery wanting to export processed silver now needs government approval for each shipment. In practical terms, that approval process adds 2 to 3 weeks to every order, and there's no guarantee the licenses get approved at all. So even as demand surges, the primary pathway for getting refined silver to where it's needed just got dramatically more complicated. And speaking of demand surging, pop quiz, how much silver does it take to build one electric vehicle with a solid-state battery? Samsung's verified specifications show their upcoming batteries require 1 full kilogram of silver per 100 kilowatt-hour battery pack. That's not a small amount. That's roughly 32 troy ounces per vehicle. And Samsung announced in December that they're targeting late 2026 for production to begin at scale. Think about what this means for our investment portfolios and retirement accounts that hold automotive stocks or precious metals. The same week that senior traders were away and unable to monitor these massive short position transfers, the same week China locked down its refining export pipeline. Samsung confirmed they're months away from needing industrial quantities of silver that the market is prepared to supply. Let me put this in perspective. If you wanted to orchestrate the perfect collision between supply disruption and demand explosion in the silver market, you'd need three elements to hit simultaneously. First, you'd need the paper futures market, where big banks hold massive short positions betting prices will fall, to be vulnerable during a time when senior oversight is minimal. Second, you'd need a major supply choke point to activate, making it harder to actually deliver physical metal even if the price signals demand it. Third, you'd need a major new industrial demand source to emerge with specific timelines that create urgency. All three elements hit during the same 7-day window between December 23rd and January 1st, the week when our risk managers weren't watching their screens, the week when China's export restrictions took effect, the week when Samsung's battery timeline became public, and the week when the Federal Reserve had to inject a record amount of cash just to keep the overnight lending markets functioning. According to the December 2025 FOMC minutes released just before the holidays, Federal Reserve officials specifically flagged concerns about elevated and volatile overnight repo rates in the banking system. They warned that reserve levels were approaching the point where small swings in demand can push overnight borrowing costs higher. In plain English, the Fed knew something was getting tight in the system even before the holidays began. Tight enough that they felt compelled to mention it in their official policy meeting notes. So when you see that $74.6 billion injection on December 31st, that's not the Fed being cautiously prepared. That's the Fed responding to stress that was already building, stress that their own meeting minutes acknowledged weeks earlier. Our central bank was trying to prevent defaults from cascading through the system during a holiday week when markets have thin liquidity and limited ability to absorb shocks. What happens when short sellers, the traders who bet prices will fall, discover they're suddenly responsible for delivering physical metal that is trading at $130 in Tokyo while they sold paper promises at $76 in New York? What happens when those same short sellers realize the transport infrastructure is booked solid and China's refineries need government approval for every export shipment? What happens when Samsung's timeline means major manufacturers will be competing for that same limited supply within months? The senior traders who returned to their desks Tuesday morning are asking themselves these exact questions right now. And according to market sources, some of them are already making phone calls to their legal departments about force majeure clauses, the fine print in futures contracts that allows for cash settlement instead of physical delivery when circumstances make delivery impossible. The trap was set during the holidays. The spring got compressed by China's export lockdown and Samsung's demand timeline. And the Fed's record repo injection proves they knew pressure was building in the system before anyone on vacation could see it coming. The question isn't whether this trap was deliberate. The question is what happens when everyone realizes they're caught in it at the same time. Now let's talk about the evidence that this wasn't just bad timing or market randomness. Let's look at the hard data that shows institutions knew exactly what was coming and positioned themselves accordingly while the rest of us were focused on holiday shopping and family gatherings. Start with the COMEX warehouses in New York, the vaults where physical silver backs up those paper futures, contracts that trade electronically every day. The COMEX tracks two categories of inventory: eligible silver, which is stored in approved warehouses, but not actively backing contracts, and registered silver, which is specifically allocated to satisfy delivery obligations on futures contracts. That registered category is what actually matters when someone demands physical delivery instead of just rolling their contract forward or settling in cash. According to CME Group data, registered silver inventory has collapsed by 70% since 2020. We're not talking about a gradual decline or normal market fluctuation. We're talking about a systematic drawdown from over 150 million ounces to roughly 45 million ounces today. To put that in perspective for your retirement accounts or investment portfolios, imagine if your bank suddenly had 70% less cash in its vaults while the number of people wanting to make withdrawals stayed the same or increased. That's the situation facing the COMEX right now. But here's what makes this particularly interesting. On December 10th, 2 weeks before that holiday ghost week we discussed, the CME Group made two significant changes to their rules. First, they raised margin requirements for silver futures from $20,000 to $25,000 per contract. That's a 25% increase in the cash traders need to post as collateral. When exchanges raise margin requirements, it's usually because they're worried about volatility or default risk. They want more cushion in case positions move against traders. The second change was even more telling. According to Federal Reserve Bank of New York documents, the Fed eliminated the $500 billion daily cap on standing repo operations on that same December 10th date. Think about that decision. Our central bank removed the safety limit on how much emergency lending they could provide to the banking system. That is like your local fire department deciding to keep every truck fueled and staffed 24/7 because they expect a major fire. You don't make that change unless you have good reason to believe you will need that unlimited capacity. These two actions, the CME margin increase and the Fed's unlimited repo facility, happened on the same day, 2 weeks before Christmas, right before that holiday period when senior traders would be away from their desks. Someone at these institutions knew that delivery pressure was building and took steps to prepare the system before the wave hit. Have you ever noticed how insurance companies raise premiums right before hurricane season starts? They're not reacting to the storm, they're preparing for what the data tells them is coming. That's exactly what happened here with the December 10th rule changes. The institutions that run our commodity exchanges and banking system saw the storm approaching and adjusted their risk management accordingly. Now, let's talk about what the Federal Reserve itself was saying internally while all of this was developing. The December 2025 FOMC minutes, the detailed notes from the Fed's policy meeting that get released 3 weeks after each meeting, contain some remarkable language that most Americans probably missed during the holiday season. Fed officials specifically stated they were monitoring elevated and volatile overnight repo rates in the money markets. For those not familiar with repo markets, here's what that means for your daily financial life. When banks need cash overnight to meet their obligations, they borrow from each other using treasury bonds as collateral. The interest rate on those overnight loans is supposed to stay stable and predictable. When the Fed describes those rates as elevated and volatile, they're saying banks are getting nervous about lending to each other even on an overnight basis. That's a warning sign that trust is breaking down somewhere in the system. The FOMC minutes went further, warning that reserve levels were reaching the point where small swings in demand can push overnight borrowing costs higher. Translation: the cushion in our banking system is getting thin enough that even minor shocks can cause interest rate spikes. And remember, this warning was documented in their December meeting notes before the holidays, before that $74.6 billion emergency injection on December 31st. So when that record repo injection happened on New Year's Eve, it wasn't the Fed suddenly discovering a problem. It was the Fed responding to exactly the scenario they'd warned about in their own meeting weeks earlier. They saw the pressure building, they documented their concerns, and then they had to act with unprecedented force when that pressure materialized during the holiday week. Let me connect this directly to your investment strategy and financial planning. When central banks warn about system stress in their official minutes, and when they subsequently inject record amounts of cash to stabilize markets, that tells you something significant is happening beneath the surface. The people running our monetary system don't use that kind of language casually, and they don't break records on emergency interventions unless they believe the alternative is worse. Now, let's examine the demand side of this equation, because the supply shortage is only half the story. Samsung's solid-state battery specifications are publicly available in their technical documentation filed with South Korean regulators. The numbers are precise: 1 kilogram of silver per 100 kilowatt-hour battery pack. Most electric vehicles today use battery packs in the 60-100 kilowatt range, with larger SUVs and trucks going even higher. Do the math with me here. If Samsung captures just 20% of the global electric vehicle battery market, a conservative estimate given their manufacturing scale and partnerships with major automakers, and if global vehicle production stays at its current level of about 80 million units annually, what does that mean for silver demand? Even if only 20% of those vehicles go electric, that's 16 million vehicles. At roughly 1 kilogram per vehicle, we're talking about 16,000 metric tons of silver annually. In troy ounces, that's roughly 514 million ounces of new demand entering the market when Samsung's late 2026 production timeline hits. Put that number next to the current global silver mine supply of approximately 830 million ounces per year, according to the Silver Institute. Samsung's battery demand alone, at just 20% EV adoption, would consume 62% of all the silver coming out of mines worldwide. That's before we account for any other demand sources. And those other demand sources are substantial and growing. Solar panel manufacturing already consumes approximately 29% of industrial silver demand, according to the Solar Energy Industries Association. Each photovoltaic panel requires silver paste for the electrical contacts. And as countries push toward renewable energy targets, solar installations keep accelerating. The International Energy Agency projects solar capacity additions will continue growing through 2026 and beyond. Then there's the AI and data center boom that's transforming our digital infrastructure. According to research from Lawrence Berkeley National Laboratory, data center power consumption has increased 53 times since 2000. Every one of those servers, Every networking switch, every power distribution unit uses silver in its circuitry and connections. As artificial intelligence computing demands scale up, think about ChatGPT, Google's AI, Microsoft's Azure AI services, the silver content in data center infrastructure grows proportionally. What happens when Samsung's battery demand hits in late 2026, competing with solar manufacturers who are already consuming nearly a third of industrial supply, while AI data centers scale up their infrastructure build-out? All three sectors need silver for applications where no cheaper substitute works as effectively. Copper doesn't conduct electricity as well. Aluminum doesn't have the same properties for photovoltaic contacts. Silver isn't just preferable for these applications, it's technically superior in ways that matter for performance. According to the Silver Institute's most recent supply-demand analysis, the global silver market has already run consecutive annual deficits between 160 and 200 million ounces for each of the past 5 years. That means the world has been consuming 160 to 200 million more ounces annually than miners can dig out of the ground. Those deficits get filled by drawing down above-ground stockpiles, the very same registered inventory at COMEX that we've watched collapse by 70%. Here's a scenario you can relate to from your own experience. Imagine if your local grocery store sold 200 more cartons of milk each week than the dairy farm could supply. For a while, they'd make up the difference from their backroom inventory. But eventually, that backroom gets empty. Then what happens? Either prices rise until demand falls, or the store starts telling customers they're out of stock. That's where we are with silver. The backroom inventory at COMEX is nearly empty after 5 consecutive years of deficit spending. The dairy farm, in this case Global Silver Mines, can't increase production quickly because it takes 7 to 10 years to bring a new mine online from discovery through permitting and construction. And now, Samsung's about to walk into the store, asking for a massive recurring order starting late next year. The institutions that raised margin requirements on December 10th understand this arithmetic. The Federal Reserve officials who warned about system stress in their December minutes understand it. The foreign banks that received those $215 million in transferred short positions during the holiday week are understanding it right now as they calculate what it will actually cost to deliver physical metal. According to market intelligence from precious metals dealers, the spread between paper and physical silver prices has been widening since mid-December. The 54 gap between New York's 76 paper price and Tokyo's $130 physical price is an anomaly. It's price discovery happening in real time as the market figures out what silver is actually worth when you need to hold it in your hand, rather than just trading a computer entry. The proof isn't in conspiracy theories or market manipulation claims. The proof is in the inventory data showing 70% declines. The proof is in the timing of rule changes on December 10th. The proof is in the Fed's own meeting minutes warning about stress before they had to act. The proof is in Samsung's publicly filed battery specifications and timeline. The proof is in 5 consecutive years of supply deficits meeting 3 simultaneous demand explosions. When you look at these pieces together, the depleted warehouses, the institutional preparations, the central bank warnings, and the converging demand tsunami, you start to see this wasn't bad luck. This was predictable. And if it was predictable, then the question becomes, who positioned themselves ahead of time and who got caught on the wrong side when the music stopped during that holiday ghost week? Let's do some math that Wall Street is doing right now behind closed doors. Math that determines whether your silver investments, your mining stocks, or your precious metals allocation is about to experience a historic repricing. This isn't speculation anymore. This is arithmetic with specific dates and unavoidable outcomes. The next Federal Reserve policy meeting happens January 27th, 2028. According to the CME FedWatch tool, which tracks interest rate futures markets, there's currently an 85% probability that the Fed holds interest rates steady at this meeting. That means no rate cut in January. If they hold as expected, the earliest possible rate cut wouldn't come until the March 18th and 19 meeting, assuming they even cut then. Why does this matter for silver prices? When the Fed cuts rates, it typically weakens the dollar and makes hard assets like precious metals more attractive. When they hold rates steady, it keeps the dollar stronger and theoretically makes commodities less appealing. But here's the critical difference this time. The short sellers trapped by those holiday transfers need physical silver regardless of what the Fed does with interest rates. Think about the position these traders are in right now. They sold futures contracts promising to deliver silver at $76 per ounce. Those contracts have delivery months, February, March, May. When a futures contract reaches its delivery month, the trader has 3 choices. Roll the position forward to a later month and pay the cost, settle in cash if both parties agree, or deliver the physical metal. Under normal circumstances, most traders just roll forward or cash settle because actually delivering physical commodities is expensive and complicated. But these aren't normal circumstances. With physical silver trading at $130 in Tokyo and transport capacity completely booked, there's no way to source metal cheaply and deliver it profitably at 76. The math does not work. So these short sellers need to either buy back their contracts at whatever the market demands, potentially 100, 130 or higher, or they need to declare force majeure and trigger cash settlement clauses. Here's where the timeline pressure becomes mathematically binding. According to COMEX delivery data, registered silver inventory is being drawn down at approximately 3 to 104 million ounces per month currently, with roughly 45 million ounces remaining and several large delivery months approaching. That inventory reaches critically low levels by late February. By early March, the registered category could be completely depleted if the current burn rate continues. Let me walk you through what happens in your investment portfolio when this timeline plays out. We're in early January right now. The February silver futures contract enters its delivery period in late January. The March contract begins delivery in late February. If registered inventory gets drawn to zero or near zero levels, COMEX faces a choice. Either allow a delivery default where shorts can't fulfill their obligations, or invoke force majeure provisions that allow cash settlement at prices that don't reflect physical market reality. Neither option prevents the broader repricing that's coming. If COMEX allows defaults, confidence in paper silver futures collapses entirely and prices spike as traders demand massive premiums for physical delivery. If COMEX invokes force majeure and forces cash settlement, physical silver immediately decouples from paper prices, as the market realizes the futures exchange can no longer guarantee delivery. Either way, the $54 gap between New York paper and Tokyo physical becomes permanent, and price discovery shifts entirely to physical markets. What's the real clearing price for physical silver right now? Tokyo is telling us it's $130, but let's be conservative in our calculation. Even if we assume Tokyo prices reflect some temporary premium due to transport bottlenecks, the evidence suggests physical silver is worth at least $100, $110 per ounce in a functioning market. That's where buyers and sellers can actually complete transactions for metal that changes hands. The convergence toward that 100 to 130 range becomes mathematically inevitable by February for one simple reason. Short sellers must either deliver metal they can't source at $76, or they must buy back their short positions at whatever price the market demands. As registered inventory approaches zero and the Fed holds rates steady through January, those short sellers run out of time and options simultaneously. Now let's project forward to what happens when Samsung's battery production timeline hits. Remember those numbers: 1 kilogram of silver per vehicle, late 2026 production start. Even if Samsung captures just 10% of global vehicle production, far below their stated ambitions, that's 8 million vehicles annually. At 1 kilogram each, that's 8,000 metric tons, or roughly 257 million ounces of silver per year. Compare that to current market dynamics. Solar manufacturing already consumes about 200 million ounces annually, according to the Silver Institute. AI and data center infrastructure adds additional tens of millions of ounces. Traditional industrial applications, jewelry, and investment demand add hundreds of millions more. Total global demand in recent years has run between 1 billion and 1.1 billion ounces against mine supply of only 830 million ounces. Samsung's 257 million ounces of new demand doesn't replace existing demand. It adds on top. Have you ever tried to buy a popular product during a shortage? Think about PlayStation 5 consoles in 2021, or graphics cards during the crypto mining boom, or even toilet paper in March 2020. Prices don't just rise gradually when supply can't meet demand. They spike dramatically as buyers compete for limited available units. Now imagine that dynamic playing out in an industrial commodity market where manufacturers need the material for production lines that employ thousands of workers and generate billions in revenue. The price required to balance supply and demand in that scenario isn't $130. It's whatever level finally makes marginal industrial users find substitutes or delay projects. For solar panels, manufacturers might redesign around copper contacts, even though performance suffers. For consumer electronics, companies might accept lower conductivity. But for Samsung's solid-state batteries, the silver isn't optional. It's fundamental to the technology's performance characteristics. According to battery researchers at academic institutions studying solid-state designs, the silver serves as a critical interface material that enables the solid electrolyte to function properly. You can't just swap in a cheaper metal without fundamentally redesigning the battery chemistry. That means Samsung and other solid-state battery manufacturers represent truly inelastic demand. They need the silver, regardless of price within reasonable limits. When you have inelastic demand meeting constrained supply, economic theory tells us price rises until either new supply emerges or demand destruction occurs. With new mine supply years away and battery technology locked in, the path of least resistance is price appreciation. Not to $100, not to $130. Those are stepping stones on the way to wherever price needs to go to either bring new supply online faster or make marginal users abandon their projects. Several mining executives and industry analysts have suggested that silver needs to reach 200 per ounce before enough new mine projects become economically viable to meaningfully increase supply. At $76, most potential silver mines don't generate sufficient returns to justify the capital investment and regulatory hurdles. At $150, some projects pencil out. At $200, development accelerates significantly. So here's the mathematical inevitability chain. COMEX registered inventory depletes by late February or early March. Force majeure gets triggered. Paper and physical markets decouple permanently. Physical price discovery moves to markets like Tokyo, where $130 is already reality. Short sellers trapped by those holiday transfers either cover at physical prices or default. Fed holds rates through January meeting, providing no dollar weakness relief for trapped shorts. By summer 2025, market fully prices in Samsung's late 2026 demand. By early 2026, manufacturers begin securing multi-year supply contracts ahead of production launch. Price rises toward the $150 to $200 range needed to accelerate new mine development. This isn't a prediction based on sentiment or momentum. This is following the logic of supply, demand, and institutional behavior to its unavoidable conclusion. The question for your portfolio isn't whether this repricing happens. The question is whether you understand the timeline and adjust your positioning accordingly. The senior traders who returned to their desks Tuesday and discovered those transferred short positions, they're doing this exact math right now. They're calculating their exit strategies. They're talking to their legal teams about contract language. They're looking at their margin requirements and their collateral positions. And some of them are probably looking at their own personal investment accounts and making very different decisions than their professional positions require. What should you take away from all of this? The holiday trap that transferred $215 million in short positions wasn't the story. The Fed's record repo injection wasn't the story. China's export lockdown wasn't the story. Samsung's battery timeline wasn't the story. Those were all just pieces of evidence pointing to the same fundamental truth. The paper silver market, built over decades of increasing leverage and decreasing physical backing, is approaching a reckoning moment. That reckoning arrives in stages over the next 60-90 days as delivery obligations meet inventory reality. It accelerates through 2025 as Samsung's timeline approaches, and industrial users scramble to secure supply. It reaches its culmination when price rises enough to either stimulate new supply or destroy enough marginal demand to bring the market back into balance. The system isn't broken, it's repricing. The question isn't whether $200 silver is possible. The question is whether $200 is enough to actually solve the supply deficit we've created through 5 consecutive years of consuming more than we produce, or whether price needs to go even higher before equilibrium returns. You've now seen the evidence, the timeline, and the math. The institutions knew this was coming. That's why they adjusted margin requirements and removed repo caps on December 10th before the holiday chaos. The Fed knew stress was building. That's why they documented concerns in their December minutes before injecting record amounts on December 31st. The market knows physical and paper have diverged. That's why Tokyo silver trades at $130, while New York paper shows $76. The only question that remains is, what are you going to do with this information now that you understand the trap, the timeline, and the mathematical inevitability of what comes next? The institutions that set this trap during the holidays are now scrambling to escape it. The short sellers who thought they were safe are discovering there's no physical metal to deliver. The COMEX warehouses are nearly empty. Samsung's timeline is locked in, and the math doesn't lie. While Wall Street panics, you now have the information they tried to bury during that holiday ghost week. The shortage is real. The timeline is certain. And the repricing to $150, $200, or higher isn't a question of if, it's a question of when. Stay informed, stay ahead. And remember, in a market built on paper promises, the people holding real metal hold the winning hand. This is your wake-up call. Don't forget to like, subscribe, and share this with anyone who needs to understand what's really happening in our markets while there's still time to position accordingly.